This is the Wade Borth Podcast, where smart ideas spark new opportunities. If you're ready to see money in a whole new way and build a life on your terms, you're in the right place.
Hello, welcome back to the Wade Borth Podcast. Today we're going to talk a little bit about something that probably a little bit uncomfortable for our industry. And so today I just want to address, it's been hitting the news lately at the time of the recording, what's really happening is, Kyle Busch, the headlines in NASCAR driver news, which I'm looking at right now, says that Kyle Busch loses $8.5 million in shocking insurance scam. And this, I want to put a little context around this. I don't know all the details. There's still lawsuits, so there's things that are hearsay. And so I'm going to be a little careful about jumping to conclusions, but I want to add a little context. I think a lot of people are seeing this and they go, oh, life insurance is a scam, so they throw their hands up. And I just want to put it in some context for people. What I want people to think about and just take a step back and say, why is this happening? Again, I look at this and I want to know more of the details because it makes me angry. I work in one of the greatest industries in the world. We do some of the most noble work in this industry. We protect families. We're delivering checks when everybody else is delivering a bill. We push money out when everybody else is grabbing money at the worst possible emotional time for people. So this industry I'm in that I love, that I've dedicated my life to, is a great industry. Not saying that there's not some bad players, not some bad actors. Definitely is. But I see this and it makes my blood boil. So I'm going to give you my perspective on it. You can take it for what it's worth, but I just want to give you some context. So what I see here is, again, so let me just frame the conversation around what was going on. And again, we don't know all the details, so I'm going to be a little cautious here. But there was this idea that put money in what they call an index universal life. I'm going to stop right there and take a step back and just share with you why we don't, as Sage Wealth in my relationship with Factum, why we don't use IULs. We've seen these, I've seen them around for 20 years. The question is, why don't we use them? I hear that quite often, because everybody uses them so much. They're quite frankly, they're easy to sell because they're easy to kind of manipulate on the illustration. And if you don't believe that, go back and look how many times the regulators have had to put restrictions on how they illustrate. So the whole point is, am I buying an illustration or buying a promise from a company? The reason why we don't use universal life or index universal life is because it shifts the responsibility and it shifts risk back to the client. Maybe even when the client doesn't realize it. And that's the part that is a little bit scary to me, and it sets up some false expectations. What was happening just in the IUL space is it's a tool like any other tool. Is it good or bad, or is it neither? It's neither in my mind. It's just a tool. How the craftsman or how the carpenter uses that tool, now that's where I think the issue can come into play, and I think that's what's happening here. So I just want to take a step back and say the conversations we're having around whole life are solid conversations. They're not the IUL conversations that are out there that we're seeing and that we're reading about. I look at this and what was happening? And again, I'm assuming, was there some sort of premium financing deal that was set up where they're borrowing money to pay the premiums and they're going to create all this net positive arbitrage? And again, those are things that I don't know all the details about, but that's my assumption. That's when I look at this, that's kind of where my mind goes. And then whoever sold it, were they setting up an expectation that was just unachievable? A couple of things going on there, but what I really would like to get across to anybody that listens to my podcast, anybody that looks at this, is I don't want this to paint the industry that I love and say, hey, the whole industry is the scam. I'll say, quite frankly, the opposite. I've advocated what we do and the products we use are the most solid. They're like the foundational piece of everything, but there's nothing flashy about them. And quite frankly, I love that about them. I love the fact that it's got these huge guarantees, but when you give huge guarantees like the whole life insurance companies do, my mutual insurance companies, these dividend-paying whole life insurance companies produce, all the good mutual companies do this. But when you give these huge guarantees, what you have to give up, it is the foundational piece of anybody's financial pyramid. It is still going to be there. It's been that way for 150 years, and it's going to continue to do that. We have to realize this idea of universal life, the chassis of universal life, only came out in the 80s when interest rates were rising and people were looking for a return. And when you start chasing just return versus understanding what all the other benefits are, now we've done a number of podcasts talking about the 8 benefits of whole life. I would encourage you to go back and listen to those, because yield is just one of them. It's certainty, it's clarity, it's guarantees. These are all parts of the benefits. And it is not an investment. You'll never hear us say this is an investment. I'm not sure how this was sold, if it was sold along that same lines. And so, again, as it comes out, I just want to put a little context, because it's easy to paint the whole industry with the brush that we see that's in the news. And I just want to take a step back and say, hey, the products that we use here are all dividend-paying whole life insurance. It's not IUL. It's one of those things that we want to be cautious of, because, again, is it the carpenter that was causing the issue? Was it the tool? But again, it's not the same tool that we use with what we do. So just want to put a little context on it. I know it's big in the news, and it was in my mind, and it's like, I got to put some context to this, because this is an awful situation these guys were put into. I feel for them. The company that they're having to deal with, it's not the first time they've had to deal with this conversation. So again, is there a bad player that's giving the industry a black eye? I really believe there is. But anyhow, I would just, if you got questions about this, if you say, how does my policy work? How's it different than what we're seeing in the news? I would encourage you to reach out and give us a call. I'd love to have that conversation, because it's so enlightening. It's so enlightening when you understand the difference between the two. I think it's all permanent coverage. Well, in a very high level, it is kind of permanent coverage, but whole life is complete, is a different animal. It works completely different. Quite frankly, it's designed, in my mind, how I see it, it's designed kind of the opposite way. They're saying, hey, let's take the very worst case scenario and let's build a product on that. What the very worst case scenario can happen from the company standpoint. They've transferred all the risk to the companies that know how to invest. They've transferred all the risk to the company that knows how to longevity, bond yield risk, all the different things, credit risk, all those are transferred to the company. Now comes along universal life, and they say, hey, we can give you a bigger yield. But like I heard in our industry, and I love Norm Baker says, there's no deals in the insurance business. No deals in the insurance business. So what does that mean? So they're going to potentially give you the big yield and this big potential and all the shiny object, the neon light that's out there. But the question is, what do you have to give up to get that? What they do, and they do it, in my mind, how I perceive it is that they do it kind of, I'll say sneakily, but they transfer the risk back to you, or back to the policyholder. Hey, if interest rates aren't up or the market isn't up and the index doesn't allow you to get that interest rate, yeah, that's on you. So now you got more insurance costs to pay. Can we change the cost of insurance? We can definitely do that. What about credit risk? And all the things that are managed typically by the insurance companies, which they know to do, by the way, they're willing to transfer back over to you so they don't have to do it. So you're taking on more risk for potential more return. That to me is an investment. Where I love whole life insurance is that they take all the risk and you get the guarantees and you get the benefits. So we're not talking yield. We're talking all the other benefits. And that to me is more of a liquidity contract, right? It's more of a savings type of vehicle where they take on all the risk and you're the one who gets the benefits. All you have to do is pay your premiums. And that's what I love about whole life. Whole life to me is the greatest foundational, toughest asset you're going to have in your financial picture. Everything else is just noise. So just understand the difference, and I would love to have a conversation with you. If you say, hey, Wade, tell me more about this. I'd love to see the difference. So the headline is, it's shocking to me. And quite frankly, the $8.5 million that they're losing, and I don't know how they're losing it in the they put a lot of premiums in, and again, so I want to see all the details versus reading just the headline, the very front cover of the story. So I know there's more coming out. I've started to see more starting to trickle out, but I wanted to put this content out just so you can have some context to it. It's like, yeah, it's similar, but it's different. So again, I'd love to have a conversation if that's something that you would like to hear more about. Like I said, I've seen these products when they first came out, not the UL back in the 80s, but the IULs. And I understand them enough to know that they're transferring risk. And if that's what you want, if that's what you understand, that's fine. But do we understand what does that really mean? A lot of times the risk doesn't show itself for 5, 10, 15, 20, 30 years because we can't see the impact of that. So it's something that needs to be managed. It's not a set it and forget it. Neither is your whole life policy. You should be engaged with it. It should have a great relationship, a close relationship with your whole life. But it's the only product. Whole life is the only product that once you pay your premium, the dividend's declared, it's guaranteed to go up and to the right. Has to go up and to the right. By contract, it's going to go up and to the right. No other product is going to do that and give you all these benefits. So again, reach out to me if you got questions. Love to have this conversation. This doesn't paint the industry. This doesn't paint the picture of the industry that I love and that I've advocated for my entire working life. So as we go through there, kind of look at this with like, who were the players? What were they trying to do? How, what I'm curious what they were promising. I mean, it seems like it's a huge amount of dollars. And I'm like, what was going on there? So love to hear kind of what your thoughts are. Put them in the comments because it's just interesting. It's going to be a topic of conversation we're going to see coming along. But just remember, this isn't whole life insurance. This is exactly the reason why we love dividend-paying whole life insurance, because it's got the guarantees. And again, is this a bad actor or is it a bad actor using a bad tool? I think that's probably how I see this playing out. There's just some bad actors using the bad tool, but don't paint the entire industry with that. So again, whole life is the foundational piece, and it is the liquidity contract that you need in your life to build everything else on. So again, if you got questions, love to hear them. Love to have a discussion. Thanks.
I appreciate you spending some time with me. Change starts with understanding, and action builds the future. We'll catch you on the next episode.